Welcome back. Let's talk about the markets, fueled by positive global cues, the employment data, US-China trade talks, the RBI bazooka from last week. Markets are holding up its strength. We've got a gain of close to about 0.5%, and the Nifty comfortably above 25,100. In fact, since the lows in the month of April, when the tariff uncertainty was at its peak, we've seen the markets rally more than about 10%. Seshadri Sen from Emkay Global is now with us to talk about the market fundamentals. We've seen the markets rally quite a bit, and now sentiment is further fueled by the RBI bazooka. The question is, what from here? What's the setup looking like for the markets from your point of view?
Hi, thanks for hosting me. So we remain constructive on the market, though the rally from the bottom of 10% has taken a little bit of the upside away. And our Nifty target for March next year is 26,000. So there's limited upside from here. However, the broad momentum remains positive. Our view is that coming into the second half, you will see a growth recovery coming into India, mainly led by consumption and discretionary consumption. One interesting aside from the RBI comments here on Friday is that rural consumption is strong, and we saw that in some of the value retailers where the top line growth has been fairly strong. On top of that, we see discretionary consumption coming back as most of the RBI cuts will be passed on to retail rather than wholesale consumers or wholesale borrowers. And that in turn will translate into strong demand for consumer discretionary items. So we remain constructive on both the growth dynamics of the economy and the overall market as we go further into FY26. The only caveat is that valuations are not as comfortable as it was a couple of months ago. But that again is cause for a little bit of caution, but not negativity.
Seshadri, good morning. Thank you for joining in a bit of an anti-consensus view on financials. You've mentioned that you are recommending that any sentiment-driven rally in banks should be sold into. But a general consensus on the street is that if there is a pocket of value right now among large caps, it is in private financials. So take us through your rationale here.
Yes, I've had this anti-consensus view for a while. The large banks, the two issues with the large banks at this stage. One is the market is underestimating the impact on margins, especially upfront, that will come. 100 basis points in a short period of time is a large cut, and with fairly decent exposure to EBLR loans for most of the large banks, what you will see is first a pretty strong margin compression. Some of that will be recovered in the second half of FY26, but you still end up in a scenario where FY27 margins, takes the full year impact of all the changes that have happened, are still lower than FY25, because in a falling rate scenario, only some part of the bank's liability franchises reprice, while the entire asset side goes in for a very aggressive repricing. That is the short-term view. The long-term view is that banks are now the large banks are now stuck in a low-growth orbit, and the 2-odd times price-to-book valuations do not yet reflect that lower growth orbit that they are in. We would be more comfortable when they are in the 1.5 to 1.7 times price-to-book zone.
Got that. That's the anti-consensus call. So as you said, right, your target on the Nifty is 26,000 by March end, which means limited upside from here on. So if you have to make money, where should you park your money? You've spoken about consumer discretionary and how the signs are that things will recover in H2. So I guess that's something that you like. What else?
We like real estate, cement, materials and cement, though, and we still like technology. Those are the sectors that we still continue to like. As far as sectors are concerned, we do expect some upside to earnings in FY26. The market's still reeling from massive cuts in FY25 earnings, and consensus has taken their forecast down to the bone. The benefits of the lower RBI rates on consumption and the benefits of lower commodity rates on margins are still to be captured in consensus estimates. So as we get into second half, we will see some earnings upgrades selectively in certain sectors. So that the way to structure portfolios to try and follow those earnings upgrades. Again, consumer discretionary is one sector which will deliver those.
So you said real estate, cement, tech, consumer discretionary. Am I missing anything?
No,
these are the four sectors that you like.
That's it.
Got that.
Yeah.
Indeed. Now, that's again, I'll dwell upon cement a bit, Seshadri, because that is also coming across as an anti-consensus call, right? After a very tough FY25 that the entire sector had, still undergoing a period of consolidation. It's still now entering a seasonally weak period as well because of the monsoons. Will the second half deliver enough for shareholders that this entire period is taken care of? Do you expect that recovery to happen in the second half of FY26?
We've seen, you're right, we've seen not just FY25, a 2-3 year period when the larger players have held cement prices. And there's been a consolidation in the sector. And as a result, cement prices have not gone up. In FY26 and 27, you will see that changing. Demand will continue to grow, and the larger players will now start to take some selective price hikes in across the country. And because they are now looking, they've now made a lot of acquisitions. They will want to take those acquired assets up to higher profitability, and price hikes is a good way of doing that. I've been tracking cements in the 90s. The thumb rule is if cement prices go up, so do the stocks. We believe cement prices, the outlook for cement prices look positive in second half of FY26, and stocks will start discounting that a couple of months or 2-3 months before that.
Thank you very much, Seshadri, for joining in. Great conversation, and look forward